All right, let's dive into a classic market puzzle. One of those times where you look at the numbers and they just don't add up. We're going to peel back the layers and find out what's really driving the market. Let's get right into it.
I'm sure you've been there. You see the headlines screaming about thousands of crores pouring into the market, but nothing happens. Or even worse, the market tanks on a day when it looks like nobody was really selling. It's confusing, right? Well, that's the exact puzzle we're going to solve together today.
So, our mystery is all about two back-to-back trading days in late February of 2026. And trust me, these 2 days tell two completely different and honestly pretty conflicting stories.
Okay, just look at this. On February 25th, the big players, the institutional investors, pumped in over 8,000 crore rupees. I mean, a massive number. And what happened? The market went basically nowhere. It was totally flat. Now look at the day before. The market tanked over 1%, and yet there was still a net inflow of over 3,000 crores. I mean, how on earth does that make any sense? This is where we got to put on our detective hats. The headline numbers, the ones that everybody sees, they're just the tip of the iceberg. To get the real picture, we need to dig a whole lot deeper.
So let's start with the most obvious piece of the puzzle, the cash market data. This is the stuff that gets reported every single evening, the direct buying and selling of actual shares.
On February 25th, this was the big headline. Over 8,110 crore rupees. That's the net amount that foreign and domestic institutions bought. You'd think that would be like a tidal wave of buying pressure, right?
Logically, that much cash should have sent the market soaring to the moon. But it didn't. It just sat there. And this, right here, is our first major clue. The cash market, it's not telling us everything. Something else is at play.
And that brings us to the hidden side of the market, the place where the really big players make their most powerful bets, the derivatives segment. And this, my friends, is where our whole mystery starts to unravel.
So let's rewind to February 24th, the day the market fell off a cliff. Now, in the cash market, the foreign institutional investors, the FIIs, they only sold a net of about 102 crores. In a market of this size, that's basically pocket change. It absolutely does not explain a 1% drop. No way.
So, if that tiny bit of cash selling didn't cause the crash, then what did? What were the FIIs really up to that day?
And there it is, the smoking gun. On that very same day, FIIs sold, get this, over 30,000 crore rupees in the derivatives market. That is what sank the market. Not the tiny cash sale, but this absolutely colossal bet that things were about to go south.
So what are derivatives really? Well, simply put, they're just contracts, things like futures and options that let big investors bet on which way the market's going to go, but without having to actually buy all the stocks. It's all about leverage, which is why a massive number like 30,000 crores has such an outsized impact on the entire market's mood.
Okay, so we know what happened, but we don't know why. Why were these institutional giants so incredibly negative? I mean, a sell-off that huge doesn't just happen in a vacuum. There had to be a reason. Turns out, there were a few storm clouds gathering. It was kind of a perfect storm of bad news. You had growing fears about AI hurting the IT sector, rising tensions between the US and Iran pushing oil prices up, which is always a negative for India, and on top of all that, it was the monthly F&O expiry, which always brings a little chaos. It was just a recipe for a sell-off. And this image? It just perfectly captures that tug of war, doesn't it? The headline cash number looked bullish, like a big green light, but underneath the surface, in the derivatives market, the bears were in total control, pulling the real market sentiment way, way down. So let's put all the pieces together. How did that massive pessimism on the 24th just completely spill over and neutralize all of that good news cash buying on the 25th? Well, a 30,000 crore sell-off creates what you might call a market hangover. The fear and the caution from an event like that don't just vanish overnight. Sellers were still feeling bold, and the buyers, well, they were pretty hesitant to push prices up aggressively, even with all that new cash flowing in. And the data from the 25th totally confirms this. Even with that huge cash inflow, FIIs were still positioned as medium bearish in derivatives. It's like they were buying stocks with one hand while keeping a firm grip on their bearish insurance policy with the other. And this is the key takeaway right here. The cash market was screaming buy, but the derivatives data, it was whispering, hey, be careful. Specifically, the put-call ratio was at 0.65.
And a PCR below 1, well, that generally signals that bearish or at least protective bets are still a huge factor.
This analysis from that day just nails it. That 8,000 crore cash injection basically ran straight into a wall of selling from traders who were still spooked from the day before. And the result? A perfect stalemate. A tug of war where the market went absolutely nowhere.
So the big lesson here is pretty simple. Cash flow is just one chapter of the story. If you want to understand what's really going on, you have to look at the derivatives data. That's where you'll find the true sentiment of the biggest players. So the next time the market's behavior doesn't quite match the headlines, you'll know exactly where to look for the rest of the story.